Good morning. It's Thursday, the 11th of April, and this is Govindraj-The broadcasting and streaming from Mumbai, India's financial capital. Our top stories and themes for the day. The stock markets are above 75,000 and closing in on the 5 trillion market cap figure. Gold prices rise further, so does smuggling all over. Why import duties should be cut. Hang Seng rises over 20% to enter a technical bull market, and China's manufacturing is on an upswing. That awful deja vu moment at Air India when unions return to flex their muscles. And why the cost of chicken could go up, and quite dramatically, and with it, your food bill.
This is a core report with Govindraj-The.
Markets are at 75,000. So the stock markets have closed above 75,000, a mark it hit the day before. Like we said yesterday, when the markets hit new highs and benchmarks, mature investors do look to take away some profits and, of course, wait to enter afresh. Now, when that will be, it's not quite clear. Logically, it would appear that the only time the market could see a bigger correction or a relatively big correction would be after the election results, because it's already priced in a victory and continuity for the present regime. We're already seeing some cutbacks in mutual fund flows, and I will come to that shortly. On Wednesday, the BSE Sensex ended up 354 points at 75,038, while the Nifty 50 closed at 22,754, up 111 points, so quite strong there. The broader indices like the mid-cap and the BSE small-cap index did a little better, though only slightly. So the overall market capitalization of firms listed on the Bombay Stock Exchange rose to nearly 402 lakh crore rupees from about 400 lakh crore rupees in the previous session, which means it made investors richer by about 2 lakh crore rupees in a single session. So in dollar terms, my sense is that we should be somewhere near the $4.8 trillion mark, and thus edging towards the $5 trillion mark in market capitalization. Please do not confuse this with GDP numbers. The stock markets are closed today in India, being a holiday for Eid. In the US, the consumer price index, a key inflation gauge, rose 3.5% in March. Now, this was higher than expectations and marked an acceleration for inflation. Shelter and energy costs drove the increase on that all items index at CNBC, adding that energy rose 1.1% after increasing 2.3% in February, while shelter costs were higher by 0.4% on the month and up 5.7% from a year ago. Following this report, traders pushed the first expected rate cut out to September. Remember, it was supposed to be in June, according to CME Group calculations, all reported by CNBC. Gold fever spreads across the globe. Gold is holding record highs and was little changed after closing at about $2,352 an ounce overnight. More than the specific price right now, which of course is high, do note that gold has now rallied more than 18% since mid-February. High prices and high duties are also leading to a slew of smuggling operations, including some obviously getting caught, like a consignment in Hong Kong, where authorities seized some $11 million worth of gold concealed as machine parts being shipped to Japan. Some 146 kilograms of gold had apparently been molded and camouflaged as part of 2 air compressors in the cargo of an aircraft parked in the city. India too is seeing a step up in smuggling, as is evident from newspaper reports all over. And obviously this is a reflection of those who are getting caught doing so, not the ones who are not. The common factor, of course, is high duties, which encourage smuggling anywhere in the world. And perhaps this is a good time, like before, to reduce duties on gold, as has been done, and gold coming into the country will always stay here, even if it idles in safes or steel cupboards. Central banks from China to India are buying up gold, and so are apparently more retail consumers, including in China. So the point being that even if there is no clear let-up in demand visible except thanks to higher prices, which is happening in India, there is some merit in gold being imported at lower duties. Oil prices decline somewhat. Oil prices have slipped back below $90 after it looked like they would take off towards the $100 mark, something oil speculators would have loved, but economists, including in India, would have feared. The American Petroleum Institute has reported crude inventories rose last week, with official government figures due later overnight, according to Bloomberg. Mutual funds are reporting outflows. We mentioned mutual fund flows earlier. The month of March saw inflows into open-ended equity mutual funds seeing a 16% decline, amounting to about 22,000 crore rupees as per data released by the Association of Mutual Funds of India on April 10. The total assets under management of mutual funds decreased by about 2%, amounting to about 53 lakh crore rupees compared to about 54 lakh crore rupees in February. So the amounts are not much and nor should be a cause for worry, but the turnaround in some ways I think is a good sign. Small cap mutual funds experienced an outflow of about 94 crores, again a small number, but throughout 24, that's 23-24, the financial year, this category saw inflows amounting to about 40,000 crores. So which means that there is a reversal happening. Categories like mid caps and large cap funds also saw lower but still positive inflows. For example, inflows into large cap categories was up 131% to 2,000 crore in March. So this also tells you that all these actions by the Securities and Exchange Board of India to dissuade investors putting their money into small cap funds is working or has worked. Mutual funds continue to launch new fund offers with some 19 open-ended and 2 closed-ended schemes in March, adding close to 4,000 crore rupees. So the breather is actually good, and it was time anyway for investors to pull out some funds or rejig them, as appears to have been the case. Mutual funds, as always, are a safer way to invest in markets as opposed to punting directly, unless, of course, you're an expert or a veteran at it. Chinese stocks continue to bounce back. We've been tracking and reporting on China stocks for the last few months, first the fall and then the rise. We also called it what goes down must come up. Bloomberg is now reporting that Chinese stocks trading in Hong Kong have now rallied to reach a key milestone as sentiment has improved following upbeat economic data and various corporate developments. The Hang Seng China Enterprises Index gained 2.1% on Wednesday, taking its advance from a Jan 22 low to more than 20%, and thus entering a so-called technical bull market for the first time since China scrapped COVID controls in late 2022. Chinese stocks have been recovering ever since Beijing took the fate of the markets in its hands, including with purchases by state funds. Bloomberg says that some global investors are starting to buy into the narrative that Beijing's policy support will be enough to revive growth, with a popular equity strategy to buy India, sell China likely having reached an inflection point, something that we reported earlier as well. Elsewhere, Fitch Ratings cut its outlook on China's sovereign credit rating to negative on Wednesday, citing risks to public finances as the economy faces increasing uncertainty in its shift to new growth models. The outlook downgrade follows a similar move by Moody's in December. Meanwhile, an interesting report by economist Neelkant Mishra and his team at Axis Bank say that the share of GDP from manufacturing in China is now rebounding after falling steadily between 2010 and 2020. Moreover, capital allocation to industry is up sharply, which in turn could put pressure on returns globally, the report says. So, when China had surplus labor but lacked sufficient capital, it outcompeted labor intensive industries globally. Given its larger economic size now, its competitiveness in capital intensive industries can now be a threat to industries globally, rather, once again, says the Axis Bank report. Moreover, not only is employment falling in labor intensive sectors, but it's also rising in capital intensive sectors. And the latter now dominate manufacturing employment in China. Now, this obviously is something for economists in India also to study a little more carefully and perhaps take away some lessons if there were some. Air India and an improbable deja vu. This is a deja vu that I never thought I would encounter, another strike being called in and around Air India after what seems like decades. Now, this is on the heels of two Air India pilot unions jumping into the Air Vistara pilot walkout fray just week before last. Remember, Air India is owned by the Tatas and Vistara is owned 51% by the Tatas and the balance by Singapore Airlines, and both airlines are set to merge at some point next year if that happens. Now, the fact that these pilot unions were active was obviously news to me, though many people who track the sector more closely perhaps knew better. Unions have been the bane of Air India and have, along with poor management, taken the airline to the precipice and precisely to this position where it was bankrupt for all practical purposes. At which point, the government finally managed to palm it off to the Tatas 2 years ago, who of course must be regretting their decision with every passing day, at least privately, even if they publicly put on a brave face. Now, the news is that the aircraft technicians of the government owned Air India Engineering Services Limited have called for a strike on April 23rd to seek resolution for their grievances, including about promotion, salary, and uniform. So, this company is still government owned, but Air India, the airline, which is Tata owned, like we said, is the key client. So, either ways, the Tatas are in for some fresh trouble. The union, which claims to have about 1,000 members, represents the fixed term employment staff, and it has a litany of grievances around notice periods, salary disparities, no revisions, and even the lack of promotions. And finally, the union is upset about what it calls unilateral changes to uniform policies and without prior consultations or consent, and says the disparities in color and quality of the uniform make them feel insecure, undervalued, and marginalized. The arrival of unions on the scene is perhaps the worst possible news for Air India. What the management must do and can do and how it must respond, even if it can, is for another day. Meanwhile, here's some news of an airline where there are no unions, at least visible to me. The stock price of Interglobe Aviation, the owner of Indigo, scaled a fresh record high of April 10th. Moreover, Wednesday's gains made Indigo the world's third largest airline in terms of value or market capitalization, according to Money Control. So, the 22% rally in the last 1 month has taken the stock of Interglobe Aviation, the operator of Indigo, as we said, to over $17.5 billion, or about 146,000 crores in total value, according to Bloomberg data quoted by Money Control, which also said that Delta Air and Ryanair Holdings are the two top airlines in the world with $30 billion and $26 billion of market cap, respectively. Why India's non-veg thali prices will rise. A couple of weeks ago, rating agency CRISIL put out its monthly thali price index, or a full Indian plate meal, saying that the cost of a home-cooked vegetarian thali had increased 7% in March to about 27 rupees compared to about 25 rupees in the same month of 2023. On the other hand, a non-vegetarian thali's price decreased 7% to about 55 rupees from about 59 rupees in the same period, according to CRISIL. Now, a vegetarian thali comprises rotis, onions, tomatoes, potatoes, rice, dal, and curd, and salad. A non-vegetarian thali has the same foods but chicken or broiler instead of dal. Now, food inflation would have been higher if broiler prices rose the same way, like let's say vegetable prices did, which are now holding at about 30% inflation levels, while pulses, which are your dals, are about 19%. But broiler prices are already inching upwards and are set to shoot up further. Broiler or chicken prices are seeing their own demand and supply forces. Demand includes more young people eating in or ordering from the KFCs and McDonald's, while supply forces range from rising costs of feeds like soya meal. I reached out to Ricky Thapar, treasurer of the Poultry Federation of India, and I began by asking him if it looked like prices were set to rise further, and more importantly, why.
If we talk about last month, like in the month of March, the broiler rates were between 95 rupees to 105 rupees per kg. This I am talking about live broiler egg farm. However, in April month, there has been significant increase in broiler rates, say from rupees 110 to 130 rupees per kg live weight egg farm, because of the Eid festival demand also.
Why is it different this time, or would you have similar demand spikes every year?
Yeah, during each festival, the demand for non-vegetarian food, whether it's a chicken or it's a mutton or if it goes high.
But you feel that this will not come down after, let's say, the festival is over?
No, because if we talk about next 2 to 3 months, we predict the broiler rates will increase. This is because the cost of production has also increased, and the reason is due to increase in poultry feed cost. The poultry feed is mainly like soybean meal and corn, and both raw material rates are going up. Now, corn, besides the livestock industry, starch industry also requires corn. Corn is maize, and now even the ethanol industry, they are using corn for the ethanol. So, as the feed cost goes high, feed cost is around 65% of the poultry feed cost. So, if cost of production goes high, we predict the rates will high. Secondly, now this is a summer season. When we talk about farmers' chick placement during summer season, few farmers they put less chick placement because wherever there is not sufficient water available. Because during summer season, the farmers require extra water for running sprinklers on the roof of poultry sheds and fogger inside poultry shed to reduce the temperature. So seeing these two conditions, the cost of production has gone high, and secondly, in summer season, the chick placement is less say 10 to 15, 20%. So we assume that the broiler rates will further high in next 2 months. It may be from rupees 120 to 150 rupees per kg live weight, depending upon the farm location.
Doesn't this happen every summer?
Yeah, every summer. If you see like during summer season, when there is extreme summer, and similarly during winter season also, the placement overall is less and the rates are high.
Are you feeling that, for example, there has been a lot of projections about extreme heat conditions this year? Is that something, and of course, there are water shortages in many parts of the country. Is that something that's likely to affect production more than before?
We predict that will affect production, and as well as farmer will prefer to give rest to the farm. Twice a year, the farmer puts farm to rest for 3 to 4 weeks, maintenance for cleaning, for whitewash or other repair works. So farmer prefers, like when it's a extreme temperature, he prefers to close the farm for 2 to 3 weeks for annual maintenance. So when the farm is closed, definitely there won't be any chick placement. So when it's all demand and supply rates. So when 10 to 20% chick placement is less during extreme summer, so definitely the rates will be further high.
So I'll come back to the rate in a moment. The other question I have is on demand. So, I mean, obviously more than 85% of India is non-vegetarian, but you're also seeing, as I understand, increased demand from the quick service restaurant chains like KFC or McDonald's and so on. So how is that impacting overall demand?
You see, now 87% of the Indian population non-vegetarians, especially the young generation. These fast food chains like Kentucky Fried Chicken, McDonald's, Subway, they have further increased the demand of chicken, because now more and more people prefer to go to these fast food outlets. The more footfall means more demand for the chicken products. These have further helped to increase the chicken demand overall. Secondly, post-COVID, now the people are more concerned about their health and are adding more protein in their diets. Today, if we talk about cost, chicken is the cheapest source of protein when we compare the cost of chicken with mutton or fish or any other protein source. So even the online companies like Licious, Tendercut, they have further made the availability of chicken more convenient by supplying at doorstep. So these fast foods, these online apps, they have further added to the easily availability and demand of chicken.
Right. So I'll just come back to prices. So you were saying that just last month prices were around 100 rupees per kilogram, and in a month or so it could go up to 150. That's almost a 50% jump. Is that something that's tenable? I mean,
It will be 120 to 150 depending upon the location. And the rate this I am mentioning is a live weight broiler X farm rate. Because when we go to dressed market, from 1 kg live weight, you get 650 grams of the dressed broiler weight.
to what extent do you see those prices going up, or to what extent? I mean, to how much rather?
When farm rate of broiler goes, the retailer, they have to increase their broiler rates, because they keep their 10 to 20% margins they keep. So accordingly, they will also increase. And especially for the cut low, you see, people prefer to go for parts. Like they want some prefer for a chicken leg or some prefer for a thigh. That will further go high.
What are the highest prices that we've seen for broilers in recent years? And are we anywhere close to that?
Yeah, last year in the month of August, September, it touched 150 rupees. So that's the highest it has gone.
So you're saying that it could go back to this level?
Very easily it will go. Because now the feed cost has also increased to up to 10 to 15%. Earlier, the corn, which was available at 18,000 rupees, and then the MSP is 20,000 something. So now the corn is available at 23,000, 24,000 rupees per metric ton. Similarly, soybean meal, it's available around 48 to 50,000 per metric ton. So feed cost has gone from 36,000 metric ton to 42,000 rupees metric ton. And this has increased the cost of production. So we predict in coming few months, the chicken is definitely rates are going to be high only.
Ricky, thank you so much for joining me.
You're welcome, sir. Thank you so much.
That was the core report with me, Govindraj-The. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.